Hi, Lee Phillips here. I've done another YouTube video on what I call non-qualified plans. Basically, using a life insurance policy to mimic a Roth IRA. And you can do that. It's pretty cool, actually. I've done it. I've done it on a number of life insurance policies for myself. So it isn't something pie in the sky that I'm just talking about. When you put the money in, cash value, it grows. The way you get it back tax-free is you borrow it back. Let me explain what happens when you borrow against the life insurance policy. The money you borrow is tax-free to you. You don't have to pay money on tax on the amount of money that you get as a loan from the bank to do your business or to build your house or whatever. That's not income to you. You have to pay it back. Well, to actually make it so that it's a loan, that means you have to borrow their money. Because if we're borrowing our own money back, that's cheating. That's not borrowing, that's getting our principal back, or getting our income, our growth back. So you actually have to borrow their money, the life insurance company's money. The life insurance company has got you over a barrel, and they've got you big time over the barrel. What they do, you borrow $50,000 from your life insurance policy. They take $50,000 of your cash value and they bring it over and they put it in a penalty box. It's still your money. They've got it. Then they loan you $50,000. Funny thing is, they've got 100% security on the money that they loan you because they've got $50,000 of your money in their penalty box. They actually take it out of your life insurance policy. So they've made you the loan. They're going to charge you interest on that loan. Every time they're going to charge you interest. They're going to charge you a 4% interest, and it might go up to 5, it might go down to 3, who knows what they're going to charge you. Lots of different formulas that they can charge you the interest on. But they are going to charge you interest on their money. The catch is, the money, the $50,000 that they've got in the penalty box, they're going to pay you an interest, a return on your money. That's reasonable. They're investing it. So they've got your money in the penalty box and they are paying you an interest on it. They're paying you 3% interest over here and they're charging you 4% interest over here. That means your net loss of 1% interest. And your agent, he'll put his arm around you and say, now Lee, where could you borrow $50,000 at 1% interest? And my answer to that is, yeah, but it's my money. There are a few policies that will guarantee in writing, and all of them will say, it is our practice. We never charge interest. I can sum that up for you in about 2 words. One starts with a B and the other one starts with an S. Any questions? BS, yes, you've never charged interest on this XYZ policy that you're selling me. The problem is you've only been selling XYZ policies for 3 years and you can't borrow the money on it for 10 years. The funny thing is, in 5 years, the insurance company isn't going to be selling the XYZ policy anymore. They'll have a new fandangled one. And when you can actually borrow money from it, the funny thing is they're going to charge you an interest. I can absolutely guarantee it. In fact, they can up the interest on you anytime they want. And they do, because that's the easiest way that an insurance company can pad their bottom line, is to up the interest on all the loans they've got out. So they've got your money, they're paying you 3, they're charging you 4. Bad deal. You know that 1% difference in the interest rate on your 30-year mortgage on your house is a big deal. Millions of dollars. Well, not that much, but tens of thousands over the 30-year life. So you have to get a policy which guarantees in writing that they will pay you the same amount of interest that they charge you. It's called a zero wash loan. The interest rates wash. There are 2 or 3 or 4 policies in the United States from insurance companies that will guarantee you in writing a zero wash loan. And as long as you've got the zero wash, then you can borrow the money back from your policy. There's no interest on it. The money in the policy grew tax-free. Let's see, if I put an after-tax dollar in, it grows without a tax, and I get it back tax-free. What have I just described? You know that as a Roth IRA. Except I can put $100,000, $200,000 a year into one of these policies. That's pretty good, guys. You do have to have the cost of insurance, and I explain all that in the other YouTube video that I've done called Non-Qualified Plans. But now you understand the borrowing effects of the life insurance. Now they're going to hold enough money in the policy to pay the premium until you die. So you can't borrow 100% of it. But when you die, the policy pays off the loan, and if there's anything left, then your beneficiaries get whatever's left after they've paid off themselves. So the insurance company is 100% secure, and if you do it right, you can make it mimic a Roth IRA, but you've got to have the zero wash loan.